Peter Maher is CEO of Ovanti, an affordability-first BNPL company innovating the space by underwriting on cash flow rather than credit score, by leveraging open banking and real-time income signals. He previously held leadership roles at Cap One and Zip and helped build BNPL products across markets and is now focusing on the US. Peter, thanks for making time for us today.
Yeah, absolutely. I'm glad to be here, Brad. Thanks for having me
Yeah.
on.
Glad to have you. So I'd love to start first, before we jump into Avanti, just take a bit about your background. So you've worked across disruptive consumer finance players. What's the through line that brought you to build this model?
Yeah, so my background, I've been in payments in one form or another for the last 12, 15 years or so. It's interesting. I have a passion for consumer finance, and I don't mean I love talking consumer finance all day. Like, what I mean is I think there's massive room for disruption. To me, Avanti and what we're building here is personal. It's a passion story. I'm glad I ended up. It's funny when you look back and you're like, how did I get here? And the random things that had to happen for it to take place. It's but I look back at, like, when I was 19 years old, like I made a poor decision or an uninformed decision, right? And I took out a small credit card, had a great spring break, defaulted on it, and essentially wrecked my credit for the better part of the next 10 years. I was almost 30 by the time I had good credit again. The wild thing is, in that process, my cash flow and my affordability actually became really strong long before my credit said I could afford anything. And I just remember thinking about how backwards that is, that credit is just a glimpse into maybe one or two things that went wrong, be it a life event, a poor decision, anything that you end up paying. Think about how much your life has changed in 10 years. Like, how does it take that long to change something around? Right. So I've always had a passion for anything that's potentially disruptive to that model and had my ear to the ground. My background in payments started out more on the B2B side, on commercial card issuing and automation of B2B payments, where I spent a good chunk of my career at Capital One, where we essentially built out their commercial card division from scratch to a major division within Capital One that really became like a high value wedge product for the broader commercial bank. In that phase, I realized I got a glimpse of, I love the chaotic period. I love building. Like, I always say, give me total chaos with total potential, and that is where I'll thrive. Once it becomes a well-oiled machine, it's only so fun. It's building and it's the journey.
A little more boring once maturity sets in.
Yeah, and it's great, and to each their own. And I can't wait until the day that Ovanti is a few hundred employees and cruising. But this will always be the period that I look back on and really just leaned into every single second. But after I left Capital One, I decided to jump into growth and startup land and worked, in payments in different capacities, chief commercial officer for a startup that was trying to be the next core banking processor for credit unions and community banks. I helped scale the go-to-market of a HOA fintech that was wanting to build a payments mechanism for homeowners out there to pay their dues in more flexible ways. And then in that process, I got connected with Larry Diamond, who is the founder of a BNPL called Zip. Mm-hmm. And he had a huge impact in my life. But what we both kind of bonded over was the drive to disrupt the credit model. And that's kind of the promise that BNPL came to the US on, right? Which is an alternative payment method for those that might not have access to the traditional payment methods. And I loved my time at Zip. I learned a ton. It's an incredible business. And I would say, of all the BNPLs, they probably do the best job of serving a consumer base with a lower credit score than the rest, right? But the other thing that really kind of just sat on me is like, it's still credit data at the end of the day. It's still credit scoring data at the end of the day. And there's so much more to it than somebody's score. You look at somebody, with a low credit profile, they might not be a homeowner. They may have multiple addresses within the last couple of years, which creates some inconsistency across bureau data and could potentially get them excluded just because of ID verification or whatnot. Right. And so it just really got me thinking, like, there's got to be a better way. And then I got reached out to by Ovanti. So we started chatting, and at first I was like a brand new BNPL in the US. I don't know.
There's some big players in that space.
There's some big players in the space, and then what it turned into, not interviews but just conversation, right? And
not the best.
Yeah, it's like if you build something on the legacy model and try and compete with the big guys that are already there doing it that way, you're going to get eaten alive, right? Or at least you're not going to change anything. You're just you commoditize yourself. Whether you're going after lower credit score consumers or higher credit score consumers, it's still credit score consumers. So then I started thinking about something that's not new. We didn't come up with the idea. Open banking's been around forever, or for at least a while, and we just tend to be slow adopters of it in the US. So started formulating the idea of if we can't compete with what is, can we compete with what's next, right? And so you look at the U.S. consumer population, and you've got well over 100 million people, depending on the source you cite, 120, 130 million people with subprime credit scores. You've got the new to credit population of expats, immigrants, young adults. You've got an almost unmeasurable audience size of gig workers, especially in that 18 to 40 range, right? Where they have income, they have cash flow, they don't have consistent employment as it's defined, and they're paid on things like a project basis in terms of their agreement. So they'll get kicked out oftentimes due to that. And then you've got a population that's just credit averse. They grew up in households of high interest revolving debt, hearing the horror stories and want nothing to do with it. When you add up all those populations, you're looking at over half the US adult consumer population that for the most part doesn't even qualify for BNPL, much less traditional credit. And so that's the market that we're here to serve. We kind of refer to them as the cash and debit first audience. And so that's where we went with how do we build a model that serves them, you know? And so that was the exciting part. Once we put pen to paper and really started thinking about it, it was like, wow, like we actually have the opportunity. Sure, we're going to be called BNPL, but like to bring deferred payments into its next era, into its next chapter by doing real cash flow, open banking based decisioning and affordability and being totally credit score agnostic.
When you take that learning that you had from Zip around speed and risk, how are you applying that to a US launch?
Yeah, I mean, the learnings are more about the industry and the audience and the consumers. We're doing a totally different model, right? Zip to me is they're a great story. They're especially for us. We're an Australian company coming to the US. They're an Australian company that came to the US, similar to Afterpay, similar to Sezzle. So there's always learnings in how those before you did it. Uh, but equally, we're kind of thinking about like what not to do or what do we have access to that they don't, right? And it's 3 years ago, AI was like a what is this kind of topic, and now it's recording our meeting and taking notes, right?
Right.
I think it's interesting, like the way in which we're approaching it is there's learnings, but also I'll give you a great example. Like 3 years ago, it would have been very difficult for any company to build a buy now, pay later deferred payment solution from scratch in 6 months with a team of half a dozen W-2s and a bunch of contracted developers and part-time employees. Not only are we doing it end to end in 6 months on an entirely new model, but we're releasing proof of concept within the next 30 days, MVP within 30 days of that, testing live with merchants and integrations and on the consumer facing product within 30 days of that with a full scale launch at the end of Q1. And the funny thing is we didn't have to acquire anybody or anything to do it other than some infrastructure partners, right? And so it's the first time really in history where it's actually almost cheaper and more efficient to build from scratch and faster than to go out and try and change up a legacy system.
And you don't even have to, it's still very important to have coders that understand and can piece together the pieces. But there was always the quality range when in your coders. Like a lot of people would say, I'm a programmer or a software engineer, but then the quality was just so varied. Now you can make C-level software engineers, B plus to A's just by running their code and having it cleaned through AI. And it's really accelerating, as you said, like time to market, the ability and stability of platforms. It's all coming together, and just the speed of execution is changing dramatically.
Yeah, absolutely. Absolutely it is. It's beyond wild. I think, I was talking to somebody the other day and they said, who's your biggest competitor a couple of years from now? And I was like, it's not who you're thinking. It's not legacy BNPL. It's the people after us that take this model and decide to do their thing with it, right? You're always learning from those that come before you on what to do and what not to do. And the rate at which people can bring an idea to reality today and the cost at which you can do it is unbelievable.
Yeah. So before we dig into the specifics on Ovanti, can you just give us a brief history on the company? You'd mentioned, overseas coming into the US. What are some of the parts of the platform or the playbook or team that you guys are bringing into the US, and what are you doing to get ready for launch?
Yeah, so Avanti is our parent company in Australia. They're a publicly traded company that a couple of years ago actually had launched a BNPL similar product in Southeast Asia. It got a lot of traction. They grew really quickly with it. And then they also had a lot of learnings from it. Ultimately, they made the decision as a company of like where they want to be when they grow up and really be long term is in the US and then go cross border from there potentially. We have some tech over there from the old product, which is actually pretty great. That we've evaluated deeply, modifying to fit into our model. And there are certain components of it that as our philosophy is launch fast and iterate faster, right? And so there are certain components of the technology that they had built for the platform they deployed over there that which could be beneficial to us with some of our iterations. But for the most part, Yatsik, our head of engineering and product, spent a long time building out Afterpay's merchant integrations business and then bringing that over to Block. With his knowledge and the people around him, we've made a lot of decisions, and where we thought we were going to adapt technology to our model, we've decided to just build it ourselves. So what we've really brought over, like our board over there is exceptional. They understand the business. They have a passion for the opportunity. They allow autonomy with visibility, right? Which is really, they spent a lot of time, money, and research on where they want to go and how they want to go in the US. I'm very grateful that they ended up aligning on me to be the person to help bring it to life. And they're trusting us to do it and do it right. And we're providing them with the visibility and the input that they need because it's valuable to us. In addition to that, as they sort of thought about where they want to be and who they want to be and how we want to be looked at from a corporate standpoint, they brought on some exceptional advisors, right? We've got advisors in New York. We've got our biggest partner advisors, Clee Capital in Australia. I've worked with advisors in the past where it's like a monthly call, right? I chat with these guys 4 or 5 days a week, and it is, where are we going? How are we doing it? How can we help? What do you need? So you've just got investors, advisors, and board members that are sleeves up, hands on, like willing to get in and really make this business happen. And I think that's unique.
Very unique. When a lot of founders go out and they get those advisors or early investors, most of the time what they're looking for is a little bit of access to that network, but sometimes it doesn't come to fruition, right? It may just stay at the advisory level, but it sounds like they're really, like you said, sleeves rolled up, hands on, trying to make sure that it's got a good run at being successful.
Yeah, and because of that, we work really well together because I know go to market, I know value proposition, I know partnerships and relationships. I don't think a lot of organizations and people, they say partnerships, but they don't really partner, right? And I've built relationships over my career that will always take a call because I've always done what I said I would do or said I couldn't do it, and we walked away. But so they've trusted me to go out and build the company with the right people that bring the right credibility and experience and build our value proposition and take it to market. But I'm also a first-time CEO, right? And so there's a lot of firsts for me. Every day there's more firsts than there are not firsts.
Sure.
And so having advisors, having board members that are willing to meet and speak weekly, and we're all around the world. So one of us is a very inconvenient time at all times, and right, that are there to give me that guidance and help me mature faster. Just like our company needs to scale quickly, so do I as a CEO. Has been priceless.
Yeah. You talked a bit earlier about moving away from credit scoring and decisioning on the underwriting side. And when we talked earlier, you talked about ID verification and how a lot of people fail at that point in the decisioning. Could you just talk over your decisioning stack? Like you mentioned open banking, income verification, cash flow views. Where are you guys diverging versus the traditional approach, like the score-led underwrite that a lot of the BNPL users use?
Yeah, and I'm happy to talk to it at a pretty high level and in detail because the reality is open banking and cash flow decisioning, it's not proprietary to us. We're using it to do what should have been done a long time ago, right? And bring consumer finance into the modern era. Think about the major buy now, pay later providers out there. And I just use them as an example because it's what I'm very familiar with across firms, Sezzle, Afterpay, Zip, Klarna. I love Affirm. but they're almost more of a traditional lender competing head to head with traditional loans and credit. But they're awesome. But for most of the BNPLs out there, the only thing you need to apply for a loan through them is name, address, date of birth, email, phone number. You or I could get those 5 bits of information on each other with a little bit of creativity, some Google searching, maybe a little GPT in about 10 minutes. So they have to have really robust fraud guardrails and risk guardrails to really have conviction that this person is who they say they are, that the data that they're pulling on them very quickly aligns and is consistent across all sources. There's no room for error with that model. At the highest level with our model, somebody doesn't have to provide that information to us, and then we make a decision based on what publicly and bureau information available we can find, and then formulate whether or not they are who they say they are. It's a lot harder for me to link your bank account and say I'm you than it is for me to get those 5 bits of information on you. So even at just the highest level, when a consumer enters our onboarding process, they'll link their bank account, and then through things like biometrics with their device that they're using and whatnot, we can make sure that the device that the person's using matches up with the person with the account that they're trying to link, all in nanoseconds, right? And then with us, very quickly through aggregator partners like a Unicity that's owned by MasterCard or a Plaid, we can pull their banking history of, call it 90 days, and that doesn't come to us. We don't see that directly. That goes into our loan management partner, where our risk and decisioning models are built into theirs. But we can very quickly, almost instantly, say like, what's the age of this account? What's the money in, money out frequency? How often are they paid? What's the average balance? We can even eventually probably say how much in payments are they making weekly or biweekly to other BNPL providers if they qualified for one, right? And provide real-time insights to them. But we can make a very, very informed decision based on their current financial situation on one, can they afford this product? Or what can they afford up to? And what sort of installments fit best into their cash flow cycle, right? And then the other thing that I love about it most is I've had a saying for years, which it applies to anything. It's not just lending, but it's amazing how many people will pay you back if you just ask for the money when they have it. Whether it's a Venmo request from your friend or whether it's a loan due date, it doesn't matter. With our decisioning engine for people that have predictable payday frequency, we can always make their due date payday plus one, right?
Huge difference in repay and payability for sure.
Huge difference, right? And so just those little things, and then the sky's the limit. With open banking data, we can see the categories that they shop at most frequently. The grocers, are they discount grocers, or is it Whole Foods, right? And if we get to the point as a business where we're offering some sort of budgeting features or anything like that,
Right.
That category, that spend data can be used for like financial wellness for the consumer in there. And we can say like, hey, if you just changed this category over the next couple of months, it could mean X in savings. Or if you thought about using us for this sort of situation, but not that, it would actually make things more manageable for you. It's really
You're
the
not just
difference.
a lending provider, right? You're more of a holistic financial
Yeah.
value add.
Yeah. And we're trying not to be viewed as a lender. We don't want to be viewed as a lender because we're not charging a consumer fees. There's no installment fees, there's no APR, there's no late fee.
Yeah.
Right. We want this tool to be so valuable to the consumer that the penalty if they don't pay us back is just that they can't use us again, or it's frozen until they pay us back. We're not going to collect on them. We're not going to report to bureaus. I think loyalty comes from delivering a product that does what it says it's going to do. And then we just have to be really buttoned up on fraud and make sure that it's mostly good actors coming in to use it.
Yeah, and to that point, so generally consumer finance, I think, is at a pretty important inflection point right now. We've got wages versus inflation, and there's a lot of pressure that's going on there on affordability, shrinking access to large cohorts of customers. How does your model meet this moment, and how are you preparing for any sort of risks that may develop as the market continues to make its direction known?
Yeah, it's I think the hypothesis, which has been validated through even other BNPL providers that tend to go towards what the traditional models deem as higher risk. It's funny because if you look across BNPL as a whole, their loss rates are actually far less than what you see from traditional credit cards and such, even though that audience is deemed on average more creditworthy. But with us, I think we manage losses through incentivizing the right repayment behaviors. If we give you 6 or 8 weeks to pay us off and pay us back in 4 payments, and you choose to do it in 1 or 2 when you maybe have a spike in cash flow, we want to reward that behavior, right? Be it if it leads to, overall trust with how much you can spend at a time, or maybe you build up credits towards being able to skip a payment. We also just want to meet consumers where they need us and where they want us, but not necessarily in any situation that's going to put them into an affordability crisis, right? So we are not the provider if you're trying to sell more Louis Vuitton handbags. Like, if you can afford a $3,000 bag, you should probably go spend $3,000 on it all at once. But we are there for anybody that wants to get tickets to take their kids to a game, or wants to get clothing for back to school or the seasonal change, or if you get into an auto accident and your insurance covers all of it but $500 or $1,000, right? That's an unexpected expense. We are there for categories that I think BNPL has been criticized for historically, like grocery and everyday spend. But we want to do things with our cash flow model, right? If you tell us that you're shopping at a grocery store, right, we'll incentivize you to do a pay us back in just a bridge to payday, one installment, right? So I do remember a time where the low gas light or the fridge is empty on a Tuesday, right? And payday is Friday. Right. You can't wait to eat, and you can't wait to get gas, right? And so, but when you're shopping at those categories, like, we want to incentivize, do not spread this out over 4 or 6 weeks. Like, just get to payday, and we're that partner for you.
Better solution than like payday loans or others that are, that have their own kind of, I guess, fame or or infamy, right? Like this.
Well, yeah, I mean, the leading indicator that I think is proof that our model is more than needed, is you look at across any business, any merchant that sells to consumers anywhere, right? In the US, it's 30 to 50% of their transactions are debit or cash. It's not because that's the preferred payment method of that consumer base. It's largely because it's the only payment method available to that consumer base. And if they could go spread it out for nothing without a high interest rate, or get a bridge to payday, they would. For me, it's buy now, pay laters providers. The incumbents are kind of innovators within a space, but like, our true competitors are the things like payday lending. That is who every customer that comes on board with us, I hope they lose one, because it's just, they need an option. And I think in today's environment, at a macro level, right, you've got economic uncertainty, you've got inflation, you've got, regardless of opinion on anything, you've got things like tariffs and such that are driving costs to the merchants, the retailers, the providers that we're working with, be it indirectly or directly. They still have to live and breathe as a company, and eventually at some point they have to pass that on to their consumers. But consumer, like, income and such is not keeping up with those rising costs. I saw something the other day, some influencer online that had found a grocery receipt from 2 years ago. And so they went back to the same grocery store and purchased the exact same items. It was twice as expensive. I don't know anybody.
And that's 2 years.
I know very few people that are making twice what they were 2 years ago.
Yeah.
Right. And so I like to believe, and I feel that, like, our solution enables customers to, in a more digestible, like, sleep easy way, address some of these concerns and address some of these rising costs without putting themselves into any kind of risky situation.
Yeah, it's a great example too, because a lot of times the inflation data gets reported at, oh, it's, a couple percentage points on a monthly basis. Well, the compounding effect of that growth leads to exactly what you just talked about. It's both margin taking, raw goods input increases, the tariff impacts on there, and wages are certainly not keeping up with that. And even when people are looking at broader, so they've got their first job and now they're adding second and third jobs in order to keep up with the affordability. It's great to have solutions like Ovanti in the space. You'd mentioned before the importance of partnerships, and it sounds like you're taking a very partner-led growth approach to the market entry. What does a great partner look like for you today? Are there any categories that resonate most, or that you're focusing on specifically?
Yeah, I mean, well, it's kind of funny. I tend to focus. People say, what verticals are you going after? And to me, it's more like, it's more about what verticals or what things aren't we going after. We're not there to finance a vacation. We'll get you home for bereavement, or we'll get you home for spring break to visit your family on an airline where a ticket is a few $100s. You're not using us to get on Emirates, right? We're not there to finance auto loans. We're not there to help people be able to buy a used or new Rolex watch for $3, $5, $10,000. We're just not a luxury brand, and we're not there for luxury goods. We're there for the things that, if it's a category that sells goods or services that everyday people want and or need access to, that's our ideal consumer. That's our ideal partner. Now, how we go to market, there's so many companies out there today. I think about Fiserv and checkout.com. I think about an orchestration layer out there called Gravy, right? I think about innovators like Shift4 and such, and it's right, like they have done such a good job of establishing trust with their portfolio of companies and partners and such, that there's a real opportunity for us to go to market together with the ones that see the vision of what we're trying to do. And luckily some of them do. But for us as an organization, from a growth and scaling standpoint, we want to have direct, intimate relationships with our end users of our app, consumers, and meet them where they need us. And we want to have direct and intimate relationships with key flagship merchants that are providing input into our product roadmap and telling us how to build it to what they need. But so much of our distribution can be focused on enabling our partners. So if we're creating a product that does what it says it's going to do and is really great, and they can be a key piece of our infrastructure, then it's in their best interest to take our product that does good, that they benefit from the more it's used, and help distribute it to their existing relationships. But partnerships go two-way. I've seen so much in the past where a company signs a partnership agreement, but really it's just one side of the table expecting the other side of the table to bring them deals and to bring them leads. Yep. We're not going to have 5 acquiring partners. We're going to have 2. And we're going to make sure that every merchant we talk to that wants to know or needs to know or is in a situation, that we're bringing our partners to the table so that they can see in them what we see in them and use them. Like it's just as important to us that we grow a partner's business as it is that they help grow ours.
So being very focused on the quality of the partnerships that you guys are creating, making sure that you're nurturing those. There's alignment in the vision on both the opportunity and the market that you want to serve. Are there channels that are showing the earliest transaction? Is it direct merchant, or is it really marketplaces, co-brands? And as you think about some of the displacing maybe some of those incumbents that are in place, are you focusing more on just what is that blue ocean that's not being served today? Or are you going to go head to head with some of the incumbents?
Yeah, I mean, I don't think we really need to go head to head with the incumbents. Like they're already going head to head, and they're trying to carve out their piece of the population, of the 20% of the population that their system actually enables them to serve. Let them fight over that. To us, the reality is we're a great complement with any of them, right? If I think it's super wise to give your customers multiple options that help your business cast the widest net. I think for us, what we're trying to do is really enable that debit cash majority. The statistic that I can't wait to get my hands on, and I've got rough metrics, but I can't put them out there because I don't know just how true that dialed they are. But I always think about from a merchant, it's like conversion, right? It's like you want to enable your customers to be able to spend more when it's justified. If somebody's buying an iPhone, they should also be able to buy a case, right? So you do want to maximize with responsibility the basket sizes of your existing customers, but then it's all about also customer acquisition in terms of new customers. And with things like inflation and rising economic uncertainty, more and more shoppers are price sensitive, are less brand loyal and more price loyal, right?
Right.
So like for us, we want to sit alongside whatever other payment methods they've decided are best for their business, but we want to enable that debit cash first consumer to be able to transact to what they want, or a little bit more maybe, or how many customers, because they're debit and cash first, didn't transact. We want them to be able to convert and come to the merchant in that situation. And so having us there as an enabler allows somebody to say like, hey, I really do want to shop at Target or Best Buy, right? But I'm going to go find it used somewhere else or on Facebook Marketplace because I can't afford the brand new one. But with a solution like ours there, they can, and they can spread it out over their next 1, 2, 3, 4 paydays.
Yeah.
Yeah.
Exactly. You mentioned before the team structure that you're benefiting from some of the, like a very low team structure and then some of the benefit of the experience that you guys had. How do you go through that decision around what do you build in-house versus what you do more partner-led, and how are you structuring that team to make sure that you're moving fast and reacting to those learnings as they come in?
Yeah. Well, so from a team structure this early and this lean, our whole thing, our biggest headwind isn't competitors really. I mean, we'll get commoditized into a bucket with them and tell somebody here's our story, but like our biggest headwind is probably going to be brand recognition, getting our name out there, right? It's a very fair point for any merchant or partner to say, like, you guys are going live in early 2026. Why should we work with you now? How do we combat that? And it's the caliber and the level and the experience of people that have chosen to leave their current career paths to come over here and be a part of this. Like everything about us is do what you say you're going to do and credibility,
Mm.
right? Partners, merchants first, and bring a lot of credibility. So, I have a little bit of credibility within the industry and partnerships, and it's been great. But then I look at like Dan, who came over to lead our operations and infrastructure build out, and for onboarding and supporting our merchants, partners, and customers. And he was the ex head of payments most recently for Nordstrom, right? And prior to that, he was up there in payments, running payments for T-Mobile. And prior to that, he was one of the top payment managers over at eBay for their global payments infrastructure. And it's like this is a person who's coming in and designing our operations and infrastructure,
He's got a little credibility.
having spent a career in their seats, right?
Yeah.
And so it's like, and that's it. Like we want to build it with the customer and the partner in mind, and it's working, right? And we've got some hires and things that we're announcing here pretty quickly, along with additional partnerships that I can't wait to get out there. But that's all based on credibility and trust. People are taking our phone calls because of the caliber and the experience of people that are making the call. And then with us, it's I said before, launch fast, iterate faster, fast and responsible. There's certain pieces of our infrastructure where it just makes much more sense to bring on a partner to do it for the first year or two until we hit scale and we can build it in-house. But then there's other things that are non-negotiables, right? Like it's easier to stand up a monolithic architecture, which is meant for like one acquire, one everything, right? But instead, we're putting our resources into ensuring that our architecture is microservices enabled so that at any point in the long term, we're not creating all this unnecessary tech debt that we have to unravel, but that when our loan management system's built, if that's what it is, right, we can launch it in parallel to the one that we've got partnered and test so that we can do things like multi-acquiring out of the gate.
Yeah, that you always hear VC investors that when they're making a decision for where they're going to place their capital, it's as much of a confidence in the idea and where it's going to go, but equally as important is who the team is that's actually leading it. And sometimes they understand that, yeah, maybe the idea is going to evolve over time, and what they're proposing today is not going to be actually what the product that's actually launched, but the team that's there has the idea, and they see the chemistry that's there, and they're really investing in what that team's going to be able to figure out, and as they evolve the problem or product. So that's exactly what you're describing. Like people are taking your calls because of who that team is and the trust that's behind it, which is so important.
Yeah, and if we can't do something, we're going to tell them that we can't do it, and when we plan to, if ever, right? And it's the biggest thing that we can do to deliver for our customers and our partners is make sure that our solution works exactly how we say it does. But it's also with the lean team and everything's, but you still have to take some risks and slow down to go fast. It's like there's there are partners out there, you could call it that, but I think of like a Stripe, right? They're a great company. They built themselves for being for startups. They're incredibly innovative. Um, you for the majority of what we need on things like issuing, processing, acquiring, like we could probably, without ever meeting a person, go in and sign up for it as a new fintech startup. Check the box. We've got that service. Great. But where's the partnership that comes out of that? And where's the people doing that for you that actually see the vision you're trying to deliver? And so it's like, hey, like we'd rather put a little more time into energy into going after, other companies that do those same things, um, where it's going to take longer to onboard them, which we've spent a lot of the last couple months working on. But when we get it right with them, they will be our partner, right? Right. We'll scale each other's businesses. So we're not interested really in just kind of plug and play for the right price. Like it's moving quick, but making sure that the pieces you're putting in place are the ones that are going to help you scale long term and not just create a bunch of headache and tech debt.
Yeah. So you'd mentioned before looking for a rollout in 2026. So in the next 12 months, what is that growth mandate? How do you know that this affordability first approach in this market is going to be working?
Yeah, yeah, absolutely. Well, so we put a lot of work into our 24-month post-launch forecasts in terms of what we know is attainable versus what we think is obtainable, right?
Yeah.
And we have mass amounts of conviction around what we know is obtainable, and that'll come out public pretty soon. But essentially, we start with the end in mind, right? It's like, what do we need to get to, and then you back into it. It's kind of like something I used to say when I first started managing people, and it was sales teams, right? I used to say like sales is one of the only books read right to left, right? Which is like
Uh,
you can't like if you don't know what the destination is, how the hell are you going to plot a route, right?
yeah.
And so we do everything with the destination in mind, and then work backwards from there to figure out like what is obtainable with what we've got from an infrastructure with from partners. From if we had a line of 1,000 merchants ready to go, how many could we actually onboard at once and responsibly? And then you use those numbers to scale up from that and kind of build a bottoms up approach. And we're very bullish about how we can scale. You know, we factored in the max amount of merchants at a certain size that we can integrate in a quarter in our first year versus our second year. We've factored in the fact that almost every merchant or partner in the world is going to be in a code freeze from mid-November or early November all the way through January, and no integrations are going to happen then, right?
It's in the last quarter of the year. That's a smart one.
Nobody's going to integrate us in November of 2026, period. So that should not be in our forecast or plan.
Right.
Right. And then we've blended the average share of checkouts that BNPLs get when they're by themselves or sitting alongside others. And we rounded down from that to make sure that our expectation is real. We factored in seasonality. We factored in the fact that merchants above a certain size are probably going to do a phased rollout with us and expose us to 10% of their traffic, not 100% in the first 60 days, right? And so the plan is there, and it's wildly obtainable, and I'm excited about it. Like most of the variables that would keep us from achieving it are in our control, which is it's scary, but it's also comforting at the same time. But that being said, like our roadmap is the most important thing ever right now, and making sure that we're meeting all compliance and KYC and regulatory framework expectations. And that's the other most important thing. But so we'll be delivering proof of concept in November, which is wildly quick. But it's I
That's
think
2 weeks, 3 weeks away, rather.
yeah, I think a lot of you hear all kind of different stories. A lot of startups and such die because they get caught up they confuse version one with minimum viable product,
Yes.
right? And it's everything that we hope this becomes and what we want to release and do. None of that matters if the minimum viable product doesn't work, right? And so proof of concept for us is likely mid-November, if not a little bit sooner, where we can actually demo the platform to consumers, partners, and merchants. No, we're not actually moving any money. Nobody's actually getting paid, but it just shows it end-to-end look and feel onboarding through repayment. Early to mid-January is when we aim to release the MVP and call it the minimum product of where we can actually, if we call it the friends and family month, is basically going to be, we're going to be giving out versions of the app to everybody, asking us to criticize it, break it, to like tell us what you love, tell us what you hate. But that's when we'll actually be able to show dollars flowing all the way through, right on a B2B integration or a consumer. And then rapidly we'll put the lipstick on the product and make it pretty and at its most basic functionality and release it to the market at the end of Q1. Live in April is the goal and the mandate. And then from there, we built a product end to end in 6 months. Well, that's fast, but we need to iterate faster.
Say that's that you're living that iterate, launch fast, iterate faster. Truly.
Yep. Yep. And I just, so much of it, in fact, not so much of it, all of it is the people, right? Like I look at Jacek on our engineering team and Dan and Barbara and Bruce on our risk team and our fractional general counsel who's going to be coming in-house and our PR and brand person. Like we've just kind of got a culture of like everything that each person's working on is tied to a deliverable that somebody else has. So like Jacek's team has to deliver a proof of concept in November, right? And so like what from the commercial and the operational and the partnerships infrastructure standpoint has to be done by when in order for that to be a possibility, right? And that's just kind of our model is focus on few things, but very high value things and move incredibly quickly on them.
It sounds from a management and goal setting perspective, almost like an OKR structure. Is that what you're using in order to manage the focus?
Yeah, well, we haven't called it an OKR structure, but yeah, similar. It's kind of like we kick off the beginning of every single week um, with an update on what got accomplished the previous week and what we're focusing on this week. And what we're focusing on this week is not the big or not the multi-week, multi-month projects. It's what component of that multi-week, multi-month project has to get done this week, and what does that mean? Who does it impact? Um, and we take a very board presentation structure to each other, right? So it's, I send updates. I told you my board is incredible and very involved. We meet at least once a week, if not more. But when I send them an update of everything we accomplished in the previous week, that's for them to read prior to our meeting, not for them to go for us to discuss in the meeting. Right. And then if they have questions or want to double click, of course, that's their right. And we can talk about that. But otherwise, we're moving straight on to the next round of deliverables.
It's
Right.
amazing
And
how often in organizations meetings are just retrospective, right? Rather than actually focused on what's actually going to move the needle in the next couple weeks.
how many meetings have you been in where the whole meeting is spent talking about what you're going to do?
Yeah.
Right. In terms of what we should do or brainstorming, for us, we're small, we're lean, but we're quick. And it's just a wildly extreme ownership where it's Yatsik and I can, we meet an hour on Mondays. And if he needs me in between, like we can always do ad hoc. But he comes to me and he says, here's what I built and delivered next week, walks me through it. And then more often than not, it's like, perfect. What's next? All right, on back to executing. But if there's criticism or debate or question, that's the time to do it, hash it out, challenge each other. But either way, we walk out of that with aligned on what's happening next. So it's cool.
So with that vision painted, like what are those critical items right now? What's it going to take to get there? That first quarter launch, and then moving on to the side, I guess that big, hairy, audacious goal that you guys have in mind?
Yeah, I mean, I think when we achieve these milestones and commitments of timeline, I think that's a big, beautiful check mark and credit to the
Yeah.
team on them accomplishing a big, hairy, audacious goal. I'm hesitant to add more goals to them between now and then. But
Smart.
yeah, they have.
Keep the focus.
Yep, they are working on 2 or 3 things at all times, and if those 2 or 3 things don't get done, somebody else falls behind. So it is extreme ownership. But the big, hairy, audacious goal is that our integrations roadmap for the first year is booked for come go live. But with the traction that we're making right now and the partnerships and such that we're actually going to be getting ready to announce over the next few weeks and over the next couple of months, I would say we're very on track to accomplishing something that in my mind is already incredible, which is taking an entirely new model in an industry that's ripe for change and building it from scratch instead of acquiring and modifying with a very lean team and bringing it to market in 2 quarters. To me, that's almost a miracle in itself, and I'm 100% confident we'll do it.
Yeah. So Peter, thanks for coming to the Growth Mandate. I really appreciate the chance to go deeper on Ovanti and your market vision. I know leaders listening will take a lot from this. Thanks very much for being here.
Yeah, absolutely. Appreciate you having me, Brad. Thank you.
Yeah, my pleasure.
It's fun.